They can do. So yeah, good morning everyone. Welcome to the second part of these monthly breakfast meetings. Obviously, a lot of you have come before, but for Gina in particular, the whole purpose of this is to kind of help you make smart decisions when it comes to managing your money and your investments. And that is purely and simply the only objective out of this. This isn't going to be a sales pitch. This is just me trying to give some impartial advice in a very relaxed and friendly environment. So please feel free to kind of ask as many questions as you want. I don't want to be talking at you for 45 minutes. And just a quick disclaimer. I've been working in financial services and wealth management for going on 7 or 8 years now. So I from graduating at uni of degree in financial accounting, I've had a keen interest in the financial markets, day trading and investing. And there is a difference between the two, and I'll cover that off a bit later. So essentially, I just want to impart onto you guys as much knowledge and experience that I've learned over those years as possible. And I'm going to be looking at this from a point of view almost as a first-time investor when looking at these different platforms. So, knowing what I know now, are they giving you the right information for you to make the informed decisions that you need, and almost not making you kind of second guess yourself? Because there is so much information out there and so many different platforms, it can almost be, I suppose, a bit of a minefield. And sometimes, not always, but sometimes these platforms can get their information wrong. So it's important to vet the information. And it's, I guess, difficult to vet what is real and often fiction. Because of course you don't know what you don't know until you know you don't know it. Yeah, and so if you don't know the right things, then these can lead to sometimes quite expensive mistakes. And that then leads into a key point of all this. In as fantastic as these platforms are, the onus is on you. Yeah, so if you make a mistake, that is down to you. And that, of course, is a big differentiator between the service that I provide, which is advised sales, providing different investment solutions, and the execution only non-advised sales, which is what all these different platforms are promoting. Having said that, I think they're fantastic, as I said, because they are encouraging people to invest from an early age, and rightly so. But again, are they giving you the right information to make the best decisions? There are also two non-negotiables whenever I look at a platform. The first thing you need to look at is, are they regulated by the FCA, the Financial Conduct Authority here in the UK? Because then they have to abide by strict rules and guidelines and regulations in order to make sure that they're doing the right thing for their customers. So it's the first thing you always want to look at, and generally speaking, that's at the bottom of the page. And the second thing is, are they covered by what's called the FSCS, so the Financial Services Compensation Scheme? Now, what they do is they protect your money up to a certain limit, which is £85,000. And so let's say one of these companies goes insolvent, or they just, walk away with your money. If they're not covered by the FSCS, that money goes with them. Okay, so they're the two non-negotiables that I'll always be looking at. And then what I'll be analysing are the different investment wrappers and the different types of investments that they provide. Because, as I said earlier, there is almost so much information out there, non-commission trading, ETFs, CFDs, passive investments, active investments, index funds, blah, 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 blah. What does all that mean, and what is right for me? Okay, so that's what this whole talk is about. So is that fine with everyone? And does anyone have any kind of things to say, any questions before I get started? No? Okay. Please, again, just feel free to shout any questions out as you have them, as and when I go through this. Now, I've been looking at various different ones. So has anyone heard of Moneybox? No? Hands up if you've heard of any of these. Okay, so we've got Moneybox, we've got Wombat. No. Nutmeg? Anyone heard nut? Few people heard nutmeg. Brilliant.
Nope.
Plum?
Nope.
Hargreaves Lansdown?
Yes.
No, a few people have. Yeah. Trading 212?
Nope.
Few people. eToro?
Nope.
Guy has. Okay. And finally, Vanguard.
Yes.
Most people have heard of Vanguard. They're one of the biggest kind of passive investors out there. How long have I got? It's already quarter past. I'm probably only going to have time to look at 4 or 5 of these, if I'm going to be honest. But I'm going to look at the ones that I think are best for someone that's just starting out. Which are ones like Moneybox, Wombat, Nutmeg, and Plum. Those are the 4 that I think that we need to start looking at if you're a first-time investor, never done this before. Then once you've kind of got a grip of things, then you can start looking at the platforms like Hargreaves Lansdown and Vanguard. Trading 212 and eToro are trading platforms. And the difference between the two is that when you are investing, you are buying into a company. Yeah. You are buying into Apple, you are buying into Microsoft, you are buying into whoever. And then you are sharing in the rewards of any growth that that company obtains. Yeah. And that company that may then pay you out things like dividends. That is investing. You are investing over a long period of time, 5, 10, 15 years plus. And that is very, very different to trading. Trading, you are simply betting on the way the price goes, whether or not it's going up or down on a particular stock. So is that clear for everyone, the difference between investing and trading? Now, I don't want to be telling anyone to start trading. You can do if you really wanted to, but the whole point of this is really trying to get people to invest. Okay, so that's why I'm not tempted to look at platforms like Trading 212 or eToro at this point. However, if you really wanted me to, obviously I can do. Is that clear to everyone? Brilliant. Okay, so what I'm going to do now is quickly just share my screen, and hopefully technology don't let me down. Can you all see that?
Yep.
Brilliant.
Yeah.
So I'm just going to get your faces up in front of me so I can see you. Right, so this is the first one. This is a company called Moneybox. And what's great about these guys, I've just got the screen in front of me, on top of me here, is that you can open not just investment accounts, but also saving accounts. So I'm going to start with the investment accounts. Now, the key thing to providing financial advice when it comes to investing is, first of all, you need to be investing as tax efficiently as possible. And the most tax efficient vehicles that are out there, as I'm sure you know, are ISAs and pensions. Beyond that, you start paying tax. Okay, so the first thing you always want to utilize is either a cash ISA or stocks and shares ISA. That is just fundamental. And with that, you've got a £20,000 tax allowance every tax year. Okay, so from the 6th of April every year, that then restarts. But you can only use, and this is almost this is the catch, you can only use one provider per tax year. So in all these different platforms and providers that are out there, you have to make the right decision on the right one, because you can't use 2, unfortunately. You can then start looking at things like general investment accounts. There's no limit to those, but then you're going to start paying tax on any gains. Okay, so that's key. Now, I said before that we need to start looking at 2 non-negotiables for every platform. Okay, so those are the FCA and the FSCS. So is this working for everyone when I'm scrolling?
Mhm.
Yep. So where does this stipulate? They're regulated by their financial services FCA. It's stipulated here. Okay, so that's the tick, and here is the FSCS protection. So click on that. Moneybox is covered by their financial services compensation scheme up to £85,000. So brilliant. Tick tick. Now let's have a look at this. So has anyone heard of Moneybox before? I don't think anyone has done. You may have seen it advertised on TV. What's really good about this is that you can use it to round up your transactions. So say you're going to Starbucks and your coffee's £2.40, let's say. You can round that up to £3, and then that 60 pence is then automatically put into your savings account or your investment. So over time, that's going to build up to quite substantial amounts. And that's what I really love about this platform. It makes it super easy to do that.
So how would you do that on like a card? Like how is that just set up so that the remainder did that just happen magically?
Yeah, so you have to ask it to do it. So on the app, when you pay,
Yeah.
it will be linked to your account. And I don't have the application myself, but I've seen tutorials of it. You will essentially have all your list of transactions, and then it will say, right, you bought a coffee, and then you swipe, and it will say add 60p or add 40p or add 30p or whatever it is. So that's how you can do it. Yeah, and then as I say, that gets automatically put into your accounts.
So if we got like an ISA somewhere else, is it could we then open up on here one of those accounts just to do savings? No, it's got to stick with one.
No, sorry, yes, you can have an individual savings account. You just can't have an ISA with these guys. Okay. Likewise, you could have a general investment account or pension, but you can't have two ISAs. So I know you've got an ISA with Hargreaves Lansdown Lucy. So you, unfortunately, unless you can start a new ISA in the new tax year, but for this 2021 tax year, unless you transfer it, you can't open a new one.
Got you.
So you could open one with Moneybox, but you'd have to transfer your money over to Moneybox.
So David,
does that make sense? Yeah.
If you have an ISA, so say Lucy's example, she's got an ISA now with another platform. If she opens one up next year, can she keep the previous ISA so she can have two?
Yes. Yeah.
Okay.
Yeah.
And they're both
two
still
different tax years.
They're both still tax exempt up to your allowance.
Exactly.
So the allowance is a combination of both, is it?
The allowance is 20,000 a year. So if you've got if you've got 1920 Hargreaves Lansdown, then that's your tax-free ISA allowance. 2021 Moneybox, and that's your tax-free ISA allowance for both of them. Yeah.
Oh, so it's not the total; it's actually per ISA.
Sorry, ask that again, Anita.
So the tax allowance, if you have two ISAs, it's per ISA. It's not the total value of those two.
No, it's per ISA, £20,000 per tax year.
Thank you.
That's
clear?
Is that clear? Yeah.
So it is more beneficial to open up a new ISA each tax year, or no?
I would say you want to stick with one provider, because the more money you've got in a pot, let's say you get 5% return on that, that's going to be a bigger return if you've got more money in your ISA.
Yeah.
If you've got lots of different £20,000 ISAs and you get 5% return, that gain won't be as good as if you've got more money in that ISA. But that's up to your individual preference, I suppose. I mean, I suppose if you've got one ISA worth 60-80k, then why not open a new one? But I wouldn't really be having lots of 20k ISAs here and there and everywhere, unless you really wanted to. It's up to you. And the great thing about all this, especially if you're investing those small amounts, you benefit from what's called pound cost averaging. Does anyone know what that is? So very simply, it's buying stocks into companies at different prices. Okay, so effectively, if the markets are going up, then you're buying at discounted prices. It's like going into, I don't know, Next or wherever you shop. and each item of clothing isn't as much as what it is in a week or so's time. And so therefore the gains are extrapolated and even better. You gain advantage of better returns over a long period of time if you invest regularly.
David,
yes, those
sorry,
amounts are going to be quite small. Yeah,
we're still on the ISAs, right?
we're still on the ISAs. This is
Okay.
just a fundamental principle of investing.
All right.
If you are investing at cheaper prices than what they are, in a few weeks' time, then the gains will be that much greater.
David, sorry,
that makes sense.
Just one question. You said that you can't transfer within the tax year, but you can.
Yeah, you can.
In the new.
Yeah.
You can
So you
in
can
the new
always
tax year.
transfer.
So when is
So you can always transfer. So today you can transfer over to another provider. There's nothing to stop you from doing that.
Okay.
You can't open up a new separate ISA until April following year. So you can always transfer, no matter when. Yeah, that's down to you.
Thank you.
Okay. Right. So let's start with this then. And with these guys as well, you can start with as little as £1. Some other platforms out there, like Nutmeg, for example, you have to start with a minimum of 500. Now that may or may not be too much for some people, but that's worthwhile knowing. So I'm gonna go ahead and click on Stock 2 Shares ISA here. Where is this? Right, Why Invest? Click here, and then get started. Hang on. Why isn't this? Trying to get onto the fund bits. Where are we? Before I get onto that, here are the fees. So with these kind of platforms, you're generally going to be paying around 1% on average per year. Now, for some of the cheaper ones, you might be being charged 0.75, some slightly higher. But all these platforms are offering kind of real cheap alternatives to mainstream stuff. So that's always worthwhile looking at. I don't know why it's not allowing me to get onto the investment part of it. Click here again and see what's going on here. It's asking me for my phone number. Here we go. Right. So you fit your money into a Stock 2 Shares ISA, and you've got the choice of 3 portfolios. Now, those portfolios are as follows: cautious, balanced, and adventurous. Now, that's great. It's 3 choices. And then within those portfolios, you've got a choice of 5 funds. And all these funds are essentially tracker funds. So if no one knows what a tracker fund is, essentially all they are doing is mirroring an index, like the FTSE 100 or the Dow Jones in America or the NASDAQ, whatever it is. So you've got 5 funds, and those 5 funds make up the 3 portfolios. And you can see that with the cautious one, you've got quite a few in corporate bonds and quite a lot in cash. Now, for those that remember from the previous talk, I said that bonds were almost your defenders. If you look at the football analogy, they are the defensive assets. They're safe, they're secure, but they're not really going to get you any goals. Yeah. And just a quick reminder, a bond is essentially a loan. So if I'm a company and I want to attract more money, I'll give out loans and I'll give a rate of fixed interest in return. They are what's called fixed interest treasuries. But unfortunately, in today's kind of economic climate, with interest rates being how they are, returns on corporate and government bonds are quite low. So when I'm talking to clients, I generally suggest a more of an equity-based portfolio, but then this is down to you. So you've got global shares, equities basically 15%, property 5%, as I say, most in bonds and cash. In balances, you expect the equity weighting is even higher, and even more so with the ventures portfolio. Okay, so this is pretty simple bog standard stuff that you would expect to see from most platforms. What I like about these guys is below, they give you an indication. Now, history, past performance is indicative to future performance, I've got to say that, but they give you an indication of what you might be getting in it with these kind of investments. So for cautious, in 2016, 16%, that's actually pretty good. Balanced, even higher. And then you'd expect with the adventurous, because you've got higher weight in equities, the returns are high also. Of course, you've got a few downturns in 2011, 2018. So I really like that. That's really simple and easy to use. And then simply, once you open an investment account or a savings account, you choose the portfolio that you want, and then you just go ahead.
So David, I just missed that bit at the end there. Just so I've got this right,
no
this website will decide exactly where your money's going. So you don't have to choose individual, you just literally choose a profile and that's it.
Yeah, I mean, they only have 5 index funds anyway. So index funds are very cheap because, as I say, all you're doing is you're mirroring an index. There's no fund manager fiddling around with things. You know, however the FTSE 100 does, that's how the fund does. You are mirroring the top 100 companies in the UK. That's all you're doing. So if all those companies fall by 30%, guess what happens to your fund? It falls by 30%. And that's why these platforms charge the amount they do, because it doesn't cost really, and it's computer-based algorithms that are doing this. There's no human interaction here. But again, for a first-time investor, there's nothing to say that's not the right thing for you when starting out. But in answer to your question, Lucy, yeah, you simply just pick one of those 3 portfolios, and away you go. Real simple. Any other questions on what I've just mentioned? What I really like here as well is they've got kind of a blog at the top that gives you some hints and tips of what to be looking at, thinking about your own pension now, crowdfunding. So Gina, that might be worthwhile for you to look at. Foundations for Success, Invest Like the Best. And I think these are super important, you know, trying to promote financial education. So if you want to have a look at these, I'd highly recommend doing that before investing. And they also have an academy as well, which is again fantastic. So how to make your money grow while you do nothing, understanding risks. These are all crucial things that one needs to know about when investing. And I said earlier, are these companies giving you the right information and the right tools to make the right decisions? That looks like these guys are. So yeah, big thumbs up for Moneybox. Sorry, Gina.
Yeah, crowdfunding seemed to be easy, but to be honest, as soon as you look into it, it's not really.
No, it's certainly not. And I said to you, you know, in May next year, that's what I'm going to be talking about is, you know, investment for business and crowdfunding. But yes, it is a bit of a minefield. But perhaps if you and I wanted to have a chat about that further after this, we obviously can do.
Perfect, thank you.
Okay, so we're already past. How time flies. Now, a similar one to actually, no, I'm gonna pass one back for now, and I'm gonna go on to Nutmeg, because Nutmeg is similar to Moneybox. However, the amounts that you need to invest are higher. So you need to start with an initial £500. The charges are relatively similar. However, what you're doing with Nutmeg, as opposed to Moneybox, similar funds. However, you are investing into what's called exchange traded funds, which are basically, you've got 2 different styles of passive investments. You've got index funds, which, as I say, simply just follow an index, like the FTSE 100. Or you've got ETFs. Now, the difference between the 2 is with an ETF, an exchange traded fund, you have someone that invests into the same companies that are in the FTSE 100, but that pool of investments can be traded as many times as you want during the day. So it becomes a tradable stock in itself. Now, when that person decides which companies should or should not be in that collective, he may decide, or he or she may go, right, okay, I'm looking at the American markets. I'm actually only going to pick the top companies that are performing well. If you look at all the technology companies that are out there, the S&P 500, for example, as the name suggests, has the top biggest 500 companies. Do you pick the top 500, or do you pick just the top 200, for example? Because there's logic to say, well, the ones that are further on down the line are so tiny, they almost pale into insignificance compared to the likes of Microsoft and Apple and Google and all these big names. So they're pretty similar, but slightly different in the way that they're traded. Just so you guys hopefully understand that. I know that's getting a bit complex, but I'm going to stop there and just hope, does that make sense to everyone, what the difference between the two is? Ask any questions if you want to. Okay, so that out of the way, that's the main difference between these two. Again, what are the two fundamental things we need to look at here? Well, are they regulated? Yes, they are. And are you protected? Yes, you are. So tick, you can continue. Why choose Nutmeg? Well, we're experienced. The person that set up Nutmeg was a trader himself, and his philosophy was, well, he just wants to make things really simple and transparent and easy to use. Again, if you look down at their products, they've got the same products. They've got pensions, lifetime ISAs, general investments, junior ISAs. I haven't covered junior ISAs, but effectively, if you've got a child and you want to invest for them, you can put £9,000 a year into a junior ISA. It acts exactly the same way as a normal stocks and shares ISA, but then the child gets access to that money when they reach 18. Okay, so it's just something to bear in mind if you wanted to open that in addition to your £20,000, because that's for someone else. So they've got pretty much the same wrappers. How it works, pretty similar to before. You set your goal, choose an investment style, and then you simply leave it to them to manage for you. So, is that clear to everyone?
Is there any idea of what sort of returns you would have historically got with Nutmeg or?
With Nutmeg, yeah, sure. So what I'll do is I'll go into this now. This is, I actually like the functionality of this website more than Moneybox. I think Moneybox, to be honest, is probably more of a family-orientated style platform, whereas Nutmeg is probably for those that have invested a bit before and want a few more choices. Because with Nutmeg, off the top of my head, how many funds did Nutmeg have? I think there's about 100 funds to choose from. And remember me saying before at Moneybox, there's only 5. So there's a lot more scope. So let's say, so what are you saving for? Well, might have a goal to buy a house or for kids or whatever. I'm going to click just invest, David's pot. And what you can also do is add an additional target amount. So let's say you wanted to target a growth rate of a certain amount to get you £30,000 at the end of the investment term. You could set that if you really wanted to. But for now, I'm just going to keep it simple. So if you click next, now term, and this is always important when it comes to looking at investing. Ideally, when you're investing, you don't want to be looking at anything less than 3 to 5 years. 5 years really should be the minimum. So if you're thinking, right, I want to invest for a couple of years, take the money out, and then happy days, I'll go buy a big house, that's probably not realistic. Realistically, what you should be doing in those situations is probably looking at the best yielding cash ISAs or savings accounts. Unfortunately, because of interest rates, as I've said earlier, are so low, you're not really going to be seeing any decent returns on those. So it is difficult. So realistically, as I say, 5 to 10 years, let's go 5 years. continue with time, 5-year time frame. Starting amount, let's start with 500, and then I'm going to be putting in 500 as well. There is a really important disclaimer at the bottom here. Before investing, you should consider repaying any debt and make sure you have enough cash on hand to cover 3 months' expenses. Now, this is also crucially important. Whenever I'm speaking to clients, it's always important to say, do you have a 3-month or 5-month emergency fund? Because when you're investing, you don't want to be investing money that you may potentially have to live on later on down the line. You know, your boiler breaks or something happens and you need quick access to money. You don't want to be accessing your investments. If you remember from what I said before, you want to be investing for growth and not income. So ideally, when you're putting this money away, you need to afford to put that money away for 5 years and not have any access to it. If you feel like you will need access to it, don't invest that money. Okay, so that is fundamental.
David,
So,
sorry.
click next. Yes, sorry.
With Nutmeg, what's the minimum you can invest every month? Is there a minimum?
Yes, so it's £100. I believe it's £100 a month, but it's a £500 initial investment.
Okay, thanks.
So you've then got 3 choices here. Again, this is a bit more experienced than what Moneybox offers. So you've got a fixed allocation. What that basically means is that you choose the weighting of whether or not the portfolio has a 60% weighting in equities and a 40% weighting in bonds. So you have a 60-40 split, and that won't change over time. That's always going to stay the same. So that's fixed allocation. And as you can see, it's slightly cheaper, 0.45% up to 100K and 0.75% up to 100K for the fully managed. The fully managed, you'll have someone in the background saying, well, actually, markets are doing well right now. I'm going to change your allocation up to 80% into equities and 20% into bonds. And that will change over time. Is everyone clear on what the difference between the two there is?
Yeah.
Yeah. So the fully managed service, funny enough, I actually just transferred a Nutmeg ISA yesterday. Their ongoing costs are 1%, which personally I think is quite high because you're not getting any advice and it's just effectively a passive fund. But I get what they're doing and I like the functionality to it. And then you've got a socially responsible model as well. I'm sure a lot of you will like. If people have heard of this term ESG, ethical, social and governance, they will basically only be investing in companies that have a positive impact on the environment, on society at large. So again, that fee is the same as the fully managed one. So if you wanted to select that, you can do as well.
So David, sorry, the other 2 pieces, the plus average investment fund cost, 0.31, etc. What does that mean?
So are you looking at here?
Yeah.
Yeah, so very good question. I'm glad you pointed that out. So the investment fund cost, remember me saying you've got a person selecting the funds that goes into a portfolio?
Yeah.
And with the fully managed, you've got someone as well dictating the split of equities and bonds. You're effectively paying that person that money. So that 0.19%. The 0.75% is just the fee that Nutmeg take.
Okay.
Per year.
Okay, and the market spread?
Now, yeah, the market spread is slightly more complicated. So basically, when you go onto a trading platform, can I quickly get this up? Let me have a look at eToro. So, just to make this clear, so top markets, right? So when you're buying and selling, there will be a difference between the buy price and the sell price.
Mm-hmm.
And that difference is going to be minimal, but it will add up over time, especially if you're making a lot of trades. So you can see here that the sell price of McDonald's is $215.86.
Mhm.
Whereas the sell price is buy price is 216.28. That's the spread. Every time you make a trade, that they are taking that difference.
Okay.
And that is important, I suppose, when you're looking at all these platforms and applications that are selling you their services on non-commission. That's all very good saying they're non-commission, but they've got to make their money somehow. There's a new service coming over from America called Robinhood, and you'll probably see that beginning of next year. No commission trading, no commission investing. Well, they've got to make their money somehow, and this is how they make their money, by taking the difference in the spread from the buy and sell price.
Right.
Does that make sense? So coming back to Nutmeg, that difference between the buy price and the sell price is going to be 0.07. That's not really something for you to worry about, because you're not trading, you're investing. But it's how these companies make their money. So don't be fooled by when people say non-commission. Yeah, these companies aren't charities. They are certainly making money somehow. Yeah.
Thank you. Yeah, makes sense.
So that's good. Thank you for pointing that out. So any other questions? God, it's already 9:15. I've only covered 2 platforms. Okay, so I'm going to...
Sorry, David, one more
God,
question
yeah.
on these charges. So these charges, to you, they make sense? They don't seem expensive, or this is standard?
It's all relative. It's all relative,
Yeah.
isn't it? So I think anything in this world, you get what you pay for. I mean, just to give an indication of my ongoing fees, they're around about 1.5%. There could be more depending on the platform and sort of portfolio that you choose, but difference with me is that you're getting an advice fee as well, and you're getting an actively managed fund.
Yep.
Okay, so you've got a fund manager that is changing the fund, the portfolio choices, the companies that he or she is investing on a daily basis.
Mm-hmm.
These are passive; they don't change that regularly. These portfolios, the funds they choose, change quarterly.
Okay.
They don't change daily. So you're paying 1%, which is great. It's cheap, but for an extra 0.5%, you'll get personally. You're getting more bang for your buck. But again, for a first-time investor, for someone that's never done this before, you're going to be looking at around a region of about 0.75 to 1% ongoing per year.
Okay.
So 1% it's bordering on more expensive, but it's still quite reasonable.
Okay, thank you.
That's all right. So your current style, again, you can choose between a scale from 1 to 10. And what's good about here, and you notice that Moneybox didn't really help you do this, help me deciding, and it shows you the categories of which risk scale you want to be in. Okay, so risk is an important part of investing. Over the long term, high risk investments tend to outperform low risk investments. How they're seen as large rises and falls along the way. So take less risk is your goals in the short term, 3 to 5 years. Okay, so I selected 5 years, so logic would take I select a low risk portfolio. Okay. Again, that's all very well and good, that little paragraph, but do you actually have anyone holding your hand through this and saying, well, actually, I think this is your attitude to risk and changing it over time? You may or may not want that. So that's something to bear in mind. So for now, I'm going to select with a slow and steady and acceptable portfolio. I'll change that after I've showed you what comes out at the end. So you can see that in the first 12 months, they're expecting you to get you a return of £116, and over 5 years, almost 3,000. And again, because this is an ISA, you can take that out whenever you want, and it's all tax-free. What you've got here is just some projections. So most likely, at the end of 2030, you're going. They are projecting. Remember, I started with a £500 investment, £500 per month is what I believe I'm doing. Around about 75,000. And you can also then see the portfolio and how it's made up of. And what's good about the Nutmeg is it clearly states that what the ETFs do. So this ETF with this corporate bond fund aims to track the performance of the market iBoxx Corporates 05 Index. Don't worry too much about that. If you really want to look into these, you can do. But for example, the Vanguard FTSE 100, this ETF aims to track the performance of the FTSE 100. Exactly what I said here earlier. There'll be a fund manager that selects the top 100 companies and puts it into a fund, and that is this Vanguard fund. Does that all make sense on the kind of how that all coincides with each other?
Yeah.
Okay. If I went back and chose a high risk portfolio, let's go 10, you would expect the returns to be greater. 183, and after 5 years, almost 5 grand. What you've got to take into account is that you're going to have swings in your fund. So one year you might do 10, 15%. The next year you might do -5. So is that clear for everyone here?
Yeah.
Any questions on Nutmeg?
Is there much of a risk by moving, say, from one, say like at the moment, like I've got in Hargreaves Lansdown, where I'm sort of like choosing where my money goes, but don't really know what I'm doing, to transfer into something like this, where, because at the moment I'm not really making anything, but because it's not easily accessible, for me, it's been a really good way to save. But I just wonder, is there any drawbacks? Like with this, it is quite accessible, isn't it? You could essentially, if you wanted to, just draw the money back out, or is that not right?
Yes. I mean, you could draw your money back out from Hargreaves Lansdown.
But you have to go on and like sell the individual, which takes a few days. And so luckily, that means that I don't do it. But I just wondered.
Yeah, I mean, that is, I think, considering I've got 10 minutes left, talking about Hargreaves Lansdown is a difficult one because it can be expensive when dealing with individual stocks. Okay. As an example, with Hargreaves Lansdown, every time, if you only do 0.0 to 9 trades a month, that's £12 per trade. So every time you buy and sell, they're taking money from your pocket.
I'm just wondering whether this is maybe better.
It might well be. It might well be if you want a simpler version. I mean, I perhaps, Lucy, me and you should sit down and talk about Hargreaves Lansdown, because again, I could probably spend a full hour just talking about them alone. But what I do like, and quickly, and I touch upon with Hargreaves Lansdown, is do you know about this wealth shortlist?
No.
So what they're doing is they are picking the best funds that they deem are most appropriate at that time.
Oh yes, it's the top whatever they call it. Yeah,
exactly. Sorry, so to be honest, I would, if you're just starting now, I've got my own stocks and shares ISA with Hargreaves Lansdown. I pick my own stocks and shares because that's what I like doing. But for someone who's not as experienced, let's say, choosing these funds or indeed choosing a portfolio, now they do have portfolios that you can go into, would be where I would start with these guys. Okay, cool. Not necessarily picking your own funds, not necessarily picking your own stocks and shares, because I mean, you can do, you can pick an Amazon, Google, Tesla, these companies are going to be around for a long time, and over a long period of time they will likely still continue to give you returns. But as I mean, look, go on our service, amount of stuff that's in it: spread betting, CFDs, foreign exchange, ETFs, investment trusts, corporate bonds and gilts. God almighty, I mean, there's so much on there. If you just want simple and easy to use, then just go use one of these free. But again, I guess I come back to my previous point: is all this stuff is do-it-yourself investments. Do you want that? Or do you want someone like me who's going to be able to give you advice in terms of the right investment strategy to use? Now that's down to you to decide, and I'm not going to kind of go on that too much. But there is. At what point would you say? Like cash-wise, you would maybe be worth moving from something like this to like having someone manage your money like you? Is there like a point where
you know, you think, well, you've got enough of a pot that it's better to, if you're not, because I'm never going to spend the time learning loads about it. I want to understand the basics, but.
So, I mean, our minimum contributions to open an ISA is only 250 a month. So it's actually less than Nutmeg.
Oh, okay.
So, you know, as long as you're contributing more than that. No, actually, so sorry, I changed. That's regulars. Sorry, regulars. So if you wanted to be putting those in per month, then that would be where we would start to look. So it depends on what your affordability criteria is and what you want to do. You know, do you want a person behind you holding your hand, or do you just want quite simply a quick app that you can go on, pick your portfolio and almost forget about it?
Yeah, I get you.
Now, again, I don't want this to be a sales trick, kind of getting you to come with me. It's up to you, completely up to you. But those are the main differences. So that's Nutmeg in essence. Is everyone clear on the difference between what Nutmeg provides and Moneybox?
Yeah. So Nutmeg doesn't have the option where it can you can set up so that if you shop in the shop and they will just round out. Yeah.
No, it doesn't, unfortunately. No.
Okay.
And that is one of the major advantages over Moneybox and Nutmeg. As I say, Nutmeg, you've got more choice. Moneybox also have that emergency fund location to put the emergency fund in, and they also have a 95-day access account, which will yield you about 0.8%, which I think is really good. Nutmeg don't have that. So here you go, Moneybox 95 rate of 0.6%, which is awful, but if you look at other savings accounts out there, it's actually quite competitive. But then Nutmeg, what I really like about Nutmeg is they have financial planning calculators. So they do almost go on this, vary on the side of financial advice. You can even see Nutmeg suggest, speak to an expert. Why Nutmeg? You know, you've got these ISA calculators, financial planning tool. I'll let you guys look at this in your own time because I'm running out of time myself here. But there is more to Nutmeg than Moneybox.
Okay.
But
thank you.
I say Moneybox have that rounding up service. One other platform that does have a rounding up service, however, I wouldn't advise using them for the simple reason that they're not covered by the FSCS, is Plum. But realistically, I wouldn't advise on them. They use another company called Gaudi, Gaudi. I don't know if you've pronounced that right, probably not. And that's where the investments are held with these guys. I think because of time, I'm going to skip these ones, and I'm going to quickly, over the last 5 minutes, because I know some of you might like this, is talk about Wombat. Now, again, these are quite similar to Nutmeg. Quick due diligence. If you look down, there should be something about the financial compensations. SEA regulated and FSCS, okay? So tick. Now, with these guys, you can invest up with a minimum of £1. I believe. Start with just £10. They've got the normal ISAs that you can go into. However, what I really liked about these guys is, if my internet loads quick enough. Let's say you want to invest in a portfolio of investments. You can pick a particular sector to go into. So let's say you want to invest into companies that promote women in power. You can click on that. For some reason, my internet's going a bit slowly, so apologies. And you can see, like, society as a whole benefits when everyone has an equal opportunity to be what they want to be. Recent studies have shown that the data backs it up to. Gender diversity has a positive impact on the company's success. Are you passionate about these companies that make it into one of the core missions to promote gender equality? So you can follow an ETF, a basket of companies that follows companies that are promoting gender equality, for example. So I really like that. And you can see the brands that they're invested in. Let's say you wanted one, and this is one that I would pick if I was with Wombat personally. Sorry, I don't know why my computer's going on. Sorry, is in AI. I think that's going to be the future personally. Tech companies, the way forward. So again, similar principles. The only issue with this is that they are only promoting direct shares. And as I said earlier, big question is, well, where are your defensive assets going to come from? As a first-time investor, do you want to be invested 100% into shares? No, you don't. Yeah, you want a diversified portfolio of equities, bonds, cash, commodities, etc., etc. You don't really want to be going 100% into equities. So I like the idea of this.
So David, with this, you would select one, and you can't actually select. Say, if I wanted AI and
you can select multiple.
Or
yeah, so you can select multiple ones.
Okay.
Yeah, but they're all going to be direct shares. That's my point.
Oh, right. Okay.
Yeah. So you're not going to have any bonds or cash or property in here. It's just going to be, direct shares into companies. And again, I can't see anywhere on here. Oh, they do have a learning hub, but where's the interaction in terms of helping me decide on the right sector? Again, information these companies provide is critical.
The worry is like,
there's all about
how often are they changing the portfolios based on how the companies are doing and putting them out of AI and putting them into Women in Power? Or like, I'd like to know the question as to why these companies are in. Whereas I'm guessing it doesn't offer that level of detail. It's almost.
Yeah, exactly. I can't see that either. And so that would be something that if I wanted to go Wombat, I would call them up and ask them. They do have a learning hub. I'm just wary with time because we're getting, if anyone needs to leave, by the way, I'll wrap up in a second. But again, as these
sorry, David, I've got to dash off, I'm afraid.
Yeah, no worries, Guy. Thanks for coming, mate.
Thanks very much. No, it's been really interesting. I've
no
really
worries.
Enjoyed it.
Cheers, Guy. Yeah, just very quickly then. So Learning Hub, similar to what other platforms are providing, an introduction to dividends, what's a portfolio, the difference between ETF and a share, which I've already mentioned before. These are all key things that you might need to read up on before deciding. But realise I'm kind of going over time there. So any questions on anything I've covered, ladies?
That was really good.
Yeah, no, I appreciate that. Was very good. Yeah,
I think I'm going to do some swapping around.
Yeah, I think it's almost looking at in our own time, like looking at those different platforms. And maybe even just for us or anyone that's interested, like maybe coming back to you then with a session where we can just have a few more questions, because I think until you go through it, it's hard, because you're going to have your own questions when you go on, and then explore it a bit more, really. So maybe, I don't know if you've got another investment topic, David, but it might be good to have one further down the line, just so almost you can then help people move on and revisit it again.
Yeah, I'll probably revisit this one actually. It's amazing how quickly time flies when we're talking about this stuff.
Lots to cover, isn't there?
Yeah, and I mean, Lucy, if you did want to talk about your ISA with Hargreaves Lansdown, whether or not it's transferring it to Wombat or whoever, more than happy to pick up with you.
Thanks. That's
another
really
day
kind.
When you're free.
That'd be really good, actually. I think I will, because when I actually look at it, I've not made any money. It's just that for me, it's the first time I've saved because I've not drawn it. But it's not actually doing anything for me. Do you know what I mean? So I think even going in a lower risk is going to give me a bit more back over time than doing what I'm doing now. So
So David, sorry, go ahead.
Yeah, go on. No, you go, Anita.
I was just going to say.
Keep saying Anita. Anna.
It's Anna.
Sorry, Anna. Sorry.
David's not
Anita in Spanish means little Anna, and I'm older than you, young man.
Don't take it personally. It's not good with names.
No, it's all right.
Anna,
don't worry.
Sorry, it's because sorry.
Yeah. So, by the sounds of it, I think you favour nutmeg over the.
If I was to choose any of them, I don't know. I like Moneybox, how they round things up.
Yeah.
But it's quite basic, and to be honest, I'm sure there's other applications out there where you could just round up with Moneybox and just use one of their savings accounts and then transfer the money from your.
If you're making a good saving anyway each month, how important is the rounding up, I guess, would be my question. That's probably a personal choice, isn't it? Yeah.
I'm not personally, I'm not going to start using Moneybox to round up my little transactions. That's not, as you say, Lucy, you could save anyway. But if you really wanted to save up into a cash, one of these notice accounts, and then transfer that cash over to an ISA on Nutmeg. But then the whole reason why I've transferred a Nutmeg ISA to us is because it's in an ETF. And again, a bit more complex, I suppose. But where markets are going over, the reason why this guy wanted to transfer them is because he thinks that the UK market and the world is going to go into a global recession if we have a look at what's going on with COVID and everything else. And all an ETF does is it tracks an index. So when markets start crumbling, that money will fall drastically. Whereas if you've got an actively managed approach like we offer, you've got a fund manager that will quickly take money out of certain companies that aren't performing well and put monies into are more defensive, like Microsoft, Amazon, Google. He will change the allocation around on a daily basis.
In a way, it's safer kind of thing.
Yes, our portfolios in periods of when markets are falling are safer.
It's protected in a way, isn't it? More protected, better protected.
It's more protected, but then you're paying more. You're paying more for it. As I said earlier, our total ongoing fees are around about 1.5% to about 1.75%. So you are paying more, but you've got to remember you're paying for a device and you're paying for a fund manager and you're paying for all the compliance or everything else that kind of goes with it. So it's more expensive, but everything in this world you pay for what you get for. You pay for what you get. So that's the reason why this chap decided to move his ISA over to us, and he's actually very he wanted it doing as quick as possible because he thought that and rightly so, over the next few weeks and months we're probably going to see a sizable correction, which is ending on a really happy note.
I know it's going to take a hit again like it did the other month. It was drastic in March, wasn't it?
Yeah, so it's worth bearing these things in mind. Don't be surprised if you go with these companies that you might see your money fall in the next year. But that's for you to. And again, these are direct offering, non-advised sales. So if you put your money with them and everything goes tits up, you can't then go to someone and say, well, why did you tell me to do that? The onus is on you with these things. So has that been helpful?
Yes.
Blown my mind.
Right.
Yeah, it's really good.
Very good.
Awesome.
It's a maze out there, isn't it? So it's really helpful.
It is a little bit of a jungle. No worries. Okay, guys. Thanks so much.
Thank you.
Thanks. Bye.
Bye.